All right, so we're diving into the world of non-bank private equity. You've sent over a ton of research, and it's really interesting to see how this area of finance has just exploded since, well, after the 2008 crisis.
Yeah, it's pretty mind-boggling when you think about it, I mean, these non-bank private credit assets have gone from just $200 billion, that's billion with a B, to a massive $2 trillion in just over a decade. I mean, these firms, they've become major players, right? And some of their practices, well, they're definitely raising some eyebrows.
Okay, so before we get into the weeds, can you give us like the private equity for dummies version?
Yeah.
Why do these non-banks even become like a thing in the first place?
Sure. Well, after that 2008 meltdown, a lot of banks got, well, understandably spooked. And they started pulling back from lending, especially that riskier lending, particularly to those middle market companies. And that's really where those private equity firms, they kind of swooped in. They saw an opportunity.
So they saw a gap in the market and thought, cha-ching.
Pretty much, yeah. They weren't as restricted by those, all those pesky regulations. They could offer higher returns to those investors, and they were much more agile. They could move faster. It's really kind of fascinating. One report I was looking at mentioned that by 2015, there was a $1.2 trillion with a T funding gap in the middle market. And while these private equity firms, they help fill it.
Wow, that's a lot of cash floating around out there.
Yeah.
But these articles you sent also mentioned some, well, let's just say interesting practices, things like zombie refinancing and these, what are they, CLOs?
Yeah.
It all starts to sound a bit like financial voodoo at that point, doesn't it?
It can seem that way, yeah. But let's break it down, make it a little simpler. I'm sure you've heard of these zombie companies, businesses barely getting by, drowning in all that debt, practically, begging for a financial, defibrillator. And, these non-bank private equity firms have become experts at refinancing these zombies, essentially, throwing them a lifeline, even if their long-term survival is, well, questionable, to say the least.
Hold on. Why would they even do that? I mean, it sounds like propping up, well, The Walking Dead. Where's the profit in that?
It's all about the fees. Each refinancing generates, well, substantial fees for the firms involved. And then they can bundle these loans, which are often risky, into these what we call CLOs, collateralized loan obligations.
CLOs. Okay. That's one of those terms that just my eyes glaze over. You think you could, I don't know, explain it to me like I'm 5?
All right, 5 years old. Let's try this. Imagine you have a giant grab bag, okay? And it's filled with all sorts of loans. Some are, good, some are bad, some are in between, a real mix. That's basically what a CLO is. Private equity firms gather up all these loans, sort them based on how risky they seem, and then slice them up into these different, what we call tranches. Think of them like different layers of a cake.
Okay. So far, so good. But why would anyone buy into these mystery cake slices?
Well, each tranche offers a different level of risk and, of course, potential return. The top layer, that's what we call the senior tranche, that's considered the safest, right? So it pays out a lower return. But as you go down those layers, the risk increases, but so does the potential payout. It's all about appealing to, different appetites, different investors.
So it's like they're spreading the risk around, like a financial game of hot potato. What happens if those bottom layers, the riskiest loans, they start going bad? That's where things could get a bit messy, wouldn't you say?
Exactly. And that is a big concern with CLOs. Yeah, I mean, they're incredibly complex. They're opaque. It's hard for even, sophisticated investors, those with experience, to really understand what's lurking in there. And if enough of those underlying loans default, it could trigger, well, it could be like a chain reaction. And that could impact, well, the whole financial system.
All right, now I'm starting to see why people are calling this a ticking time bomb. And all of this was already happening before the pandemic hit.
Oh, yeah. Oh, yeah, these trends were well underway. But then the pandemic, well, that threw gasoline on the fire.
So how did COVID change things? Did it just make things worse, or did it create entirely new trends?
It was a bit of both, actually. I mean, the pandemic created this whole new breed of, let's call them distressed companies ripe for the picking, right? And well, those private equity firms, they were more than happy to oblige. Plus, do you remember all that quantitative easing? It just flooded the market with all this cheap money, and it drove those investors desperate for any kind of decent yield straight into the arms of private credit.
So even more money pouring in.
Yeah.
But the articles you sent, they suggest it wasn't just about throwing money at any struggling business, right? These firms, these private equity firms, they got a lot more strategic during the pandemic, right? especially when it comes to the zombie companies and those CLOs.
Oh, absolutely. It was actually quite fascinating to see how they adapted, to the chaos, the economic chaos. We saw longer loan terms, fewer protections for those lenders. And they even started incorporating those pandemic era government guarantees into the CLOs, basically using that government safety net to sweeten the deal for those investors.
Wait, they were using taxpayer-backed guarantees to make these risky investments look better. That sounds like playing with fire, wouldn't you say?
It's definitely, well, it's a controversial tactic for sure. And it
Hmm.
kind of highlights, well, the blurred lines between those public and private interests. But the pandemic, it also pushed them to get creative in that secondary market. You remember all those distressed loans, the ones those banks were desperately trying to get rid of, to offload? Well, private equity firms, they swooped right in, bought them up at, well, bargain basement prices. And they did this through these things called forward flow agreements.
Forward flow agreements. Okay, another one of those terms that just, my head spins. Layman's terms. Possible.
Okay, so basically it's a prearranged deal. The private equity firm, they commit to buying a certain amount of loans from a bank, but in the future, right? And they often get a nice little discount. It lets banks offload some of that risk, and the firms, well, they scoop up assets for cheap.
So they were playing both sides, lending and buying up that distressed debt. They certainly know how to capitalize on a crisis, don't they? But these practices, I mean, it seems like they're concentrating even more risk. One of the reports mentioned that just a handful of firms now control a huge chunk of that CLO market.
It is a major concern, yeah. I was looking at some Federal Reserve data, and it is, well, alarming. The top 10 private credit managers, they now control a whopping 43% of that middle market CLO issuance. It's a significant jump, from those pre-pandemic levels. And it raises, well, serious questions about, vulnerabilities in the system.
It's starting to feel like one of those Jenga games, that tower of debt just getting taller and wobblier with every passing year. What happens when one of those blocks get pulled out? Makes you think, doesn't it? But you mentioned something earlier that really caught my attention. This idea of what was it, a liquidity mirage
Right.
in these private credit markets?
hmm
Can you unpack that a bit? I mean, what does it even mean? And why should we care?
Yeah, it's a fascinating concept. On the surface, it looks like these markets have tons of liquidity, trillions of dollars just sloshing around. But the reality, well, it's much more nuanced than that.
Okay, so give us the behind-the-scenes view here.
Yeah.
What are some of the red flags that investors should be watching for?
Well, one major issue is the illiquidity of the secondary market, for these private credit assets. You'd think they have about $150 billion in assets under management, right? But the secondary trading volume, it's surprisingly low, less than $12 billion annually. So if investors suddenly need to cash out, well, they're going to face some steep discounts,
Sure.
especially if there's, market stress, a crisis.
So it's like everyone trying to get out of, a crowded theater.
Hmm.
But there's only one revolving door. A few might make it out. But if there's a panic, well, you got a real logjam. Any other red flags we should be aware of?
Yeah, another issue is how these private credit funds report what we call their net asset values, their NAVs. They use these internal valuation models that, well, they smooth out those returns, makes everything look nice and stable. But in reality, those underlying assets could be way more volatile, much more volatile than those rosy numbers suggest.
So like those carefully curated Instagram feeds,
Yeah.
right? Everything looks perfect, but, well, reality might be a different story. Anything else, any other warning signs we should be aware of?
Well, we also have to think about those concentration feedback loops within the CLOs, I mean. A staggering, this number is just crazy. 68% of those 2023 CLO issuances, they contained overlapping exposures to the same PE-sponsored companies. So if one company starts to struggle, well, it could ripple through multiple CLOs, amplify the risk. It's a domino effect.
It's like building a house of cards on
Yeah.
top of another house of cards. The whole thing just becomes, incredibly fragile. And I know we've just scratched the surface here. You mentioned earlier that there are even newer structural vulnerabilities emerging in those CLOs. What are they, and why should we be concerned about them?
Well, it seems like those financial engineers, they're always pushing the limits, aren't they? Creating these complex and potentially very risky instruments. One thing we're seeing now is the use of these recycling provisions. They allow a larger portion of the proceeds from repaid loans to be, plowed right back into new loans, often even riskier ones.
So they're taking the money that should be going back to investors and using it to fuel, well, even more lending and potentially exposing those investors to even more risk. That's a slippery slope if I've ever heard of one.
Definitely a development worth watching, yeah. And then there are these bifurcated tranches, where that supposedly safest part of a CLO, the senior notes, well, they're being bundled with more, let's say, esoteric assets. Things like, I don't know, litigation finance claims. It's like mixing, I don't know, oil and water? Or maybe oil and dynamite?
I can't imagine those two mixing well.
Yeah.
Are there any other developments in the CLO world that are, giving you pause?
Leverage layering is another one. These private equity funds, they're often using debt to boost those returns, both at the fund level and within those CLO structures themselves. It's a strategy that can be great, magnify gains when things are good, but it also magnifies losses when things go south.
Like they're playing, I don't know, financial Jenga with a stack of dynamite.
Yeah.
One wrong move and the whole thing goes up in flames. So given all these risks, I mean, what are regulators doing about these new CLO structures? Are they even aware of what's going on?
They are aware, and they're definitely scrambling to catch up. But it's like a constant game of cat and mouse. They close one loophole, and those financial wizards, well, they find a new way to slip through the cracks.
So what specific regulatory responses are we seeing? Any new rules in place to try and, I don't know, rein in some of these practices?
There have been a few attempts, yeah. For example, Basel V now includes a 25% risk weight add-on for, bank investments in those unrated CLO tranches, trying to discourage banks from, taking on too much risk in this market.
So they're trying to make these investments less attractive to banks. But what about those non-bank players, the ones driving all this activity? Any regulations aimed specifically at them?
Well, the SEC has implemented what they call the private funds rule. Requires more transparency, more reporting from those larger private equity firms. It's a step in the right direction, for sure. But some people argue it doesn't go far enough.
It sounds like playing catch-up. What about internationally? Are there any efforts to coordinate regulations across borders, especially with all that cross-border arbitrage we were talking about earlier?
Yeah, the European Securities and Markets Authority, or ESMA, they've introduced these liquidity stress tests for EU funds involved in these private credit strategies, trying to make sure those funds have enough liquid assets, to withstand a shock, like a financial fire drill.
Seems like a piecemeal approach, trying to address specific issues as they pop up. But is it enough? Or are we still way behind the curve?
That is the million-dollar question, isn't it? The Fed estimates that only about 35% of that non-bank lending activity is, actually under proper oversight. That means there's a huge chunk of this market, well, operating in the shadows.
It's like trying to wrangle a herd of cats, isn't it?
Yeah.
They're always finding a new way to slip through the cracks. But it's not just about those regulators, right? What about the investors themselves? Are they starting to, I don't know, wise up to the risks involved in all of this?
Yeah, some are, especially those savvy institutional investors like, I don't know, pension funds, insurance companies. They're realizing they can't just rely on the goodwill of those private equity managers. They need to be more proactive.
So how are they doing that? What kind of strategies are they using to protect themselves in this wild west of finance?
One thing we're seeing is a shift towards those direct origination platforms. Instead of going through those private equity firms, they're setting up their own platforms, to invest directly in companies. Gives them more control over the process.
Makes sense. Cut out the middleman, get closer to the source. Any other strategies they're using?
Diversification. Always a smart move, right? Many of those North American insurance companies, for instance, they're using offshore reinsurance vehicles to diversify their capital. It's like, don't put all your eggs in one basket, right?
Spreading the risk. Always a good idea. Any other notable trends in, the investor landscape?
ESG considerations. They're becoming really important. Investors are pushing those private equity firms, to think about environmental, social, and governance factors. It's not just about the bottom line anymore. We're even seeing more sustainability-linked private credit deals, where interest rates can adjust based on the borrower's ESG performance.
So using their money to encourage more responsible behavior. Interesting how these ESG considerations are, well, making your way into even the most opaque parts of the market. But what about, those everyday investors, the ones without millions to throw around? Are they waking up to the risks involved here?
Well, unfortunately, those retail investors, they often don't have as much access to information,
Yeah.
fewer options to manage risk. They're exposed to these strategies through things like, I don't know, interval funds, non-traded BDCs. And these things hold billions in, these very illiquid credit assets.
So they're at the mercy of, the market and the fund managers. Bit concerning, wouldn't you say? But let's shift gears for a second. I want to talk about some real-world examples. We've been discussing zombie companies and CLOs, but it's all bit abstract.
Yeah.
Can you give us some case studies to show how these things play out in the real world?
Sure, sure. One striking example is the restructuring of Casino, that French retail giant, back in 2023. It's a classic case of a zombie company, kept afloat by a web of, well, debt, and a whole lot of refinancing deals orchestrated by, you guessed it, private equity firms.
Okay, so take us inside that boardroom. Who were the key players, and how did this whole restructuring, how did it unfold?
So Casino, they'd been struggling for years, right? Weighed down by just an enormous amount of debt. They were the definition of a zombie company. But those private equity firms, they saw an opportunity. They swooped in, offered to restructure that debt and inject some, much needed capital.
So they were coming in as the knights in shiny armor, but I'm guessing it wasn't entirely altruistic, right?
Well, the restructuring involved some complex maneuvers, like debt for equity swaps, which gave those firms a big ownership stake in Casino. They also, they negotiated some very favorable terms for themselves, big fees, nice interest payments.
So extracting value from a company that was already struggling and gaining control over its future. Pretty clever. But was it in the best interest of Casino and its other stakeholders?
It's a debate that continues to this day, yeah. Some people say the restructuring was absolutely necessary, to save the company from collapsing completely. Others argue it was just, wealth transfer from those creditors and shareholders to those private equity firms.
It's a good reminder that these deals are rarely black and white, aren't they? Winners and losers. And the line between savior and, opportunist, it can be pretty blurry. But what about those CLOs? Can you give us an example of, how they've actually played out in the real world beyond all those theoretical tranches and risk layers we were talking about earlier?
Yeah, sure. One interesting case study is how CLOs performed during the pandemic. Despite all that economic turmoil, the unprecedented economic turmoil, they were actually surprisingly resilient. Data from S&P Global shows that from 1994 to 2024, there were only 64 defaults out of thousands of CLO ratings. So they weathered the storm better than a lot of people expected.
So they held up better than expected. Why do you think that is? Just luck? Or was it something about, the structure of these CLOs that provided some kind of buffer?
Probably a combination of factors, yeah. First, those underlying loans and CLOs, they're often senior secured loans, so they have a higher claim on the company's assets if things go belly up. Second, that CLO structure itself, it provides some built-in diversification, spreading the risk across multiple borrowers, kind of like a safety net.
So the structure itself might offer some protection, but does that mean we can just, relax and stop worrying about the risks associated with CLOs?
Not so fast. There's been a concerning uptick in defaults lately, particularly in 2024. Suggests those CLO structures might be more vulnerable than we initially thought, especially with those rising interest rates and, a less forgiving economic climate.
It's a good reminder that past performance, it doesn't guarantee future results, right? And as these CLO structures become more and more complex, opaque, it's harder to really assess the risk hiding beneath the surface. But let's step back for a minute. We've talked about, specific practices, the risks, the regulations. But what does it all mean for, the average person out there? Why should they care about what's happening in this seemingly obscure corner of the financial world?
That's an important question, because the truth is the world of non-bank private equity, it's not just confined to Wall Street anymore. It affects businesses, jobs, even those hard-earned retirement savings.
Okay, bring it home for us. Give us some real-life examples of how these practices are affecting, Main Street.
Sure. Take the rise of those zombie companies. When those private equity firms prop up those struggling businesses, it can actually stifle economic growth. They hoard resources, they stifle competition, prevents healthier businesses from emerging and thriving.
So it's not just about the risk of some kind of financial contagion. There are real-world consequences for jobs, innovation, the whole economy. It's almost like a financial zombie apocalypse, isn't it?
That's a good way to put it. And then there's the potential impact on, retirement savings. As those pension funds, those insurance companies, as they put more and more money into private credit, it exposes retirees to more risk. Remember those liquidity issues we talked about? If a market shock forces them to sell those illiquid assets at fire sale prices, it could decimate those retirement nest eggs, the ones people have worked their whole lives to build.
That's a sobering thought. So these complex financial instruments can have very real, very tangible consequences for people's lives, their livelihoods. It's not just a game for Wall Street. It affects us all.
Exactly. And that's why it's so crucial to understand what's going on, even if it seems like a far-off world. Those decisions made in those boardrooms, they have ripple effects that reach, well, far beyond the financial sector.
Couldn't agree more. We've covered a lot of ground today, from the rise of these non-bank private equity firms to the complexities of those CLOs, the challenges of regulating this industry. It's also so fast-moving. But I think it's important to end on a note of empowerment. What can individuals do to protect themselves? Advocate for more transparency, accountability in this market. It can feel a bit overwhelming, but can the average person, can they really make a difference?
Oh, absolutely. Knowledge is power. There are several things individuals can do. First, educate yourself. Learn about the risks involved in private credit and those CLOs. Don't be afraid to ask questions about your retirement investments, how they're being managed. Second, support organizations that are pushing for more transparency, better oversight of the financial system. There are groups out there fighting the good fight. And finally, engage with those policymakers, Make your voice heard. Demand stronger regulations that protect investors and the whole economy.
It's a reminder that we all have a role to play, right, in shaping a more stable, a more equitable financial system.
Yeah.
We can't just sit back and assume that, well, that someone else is going to take care of it. We need to be informed, engaged, and hold those in power accountable. Thanks for sharing your insights today. Really fascinating discussion.
It's been my pleasure. And remember, knowledge is power. The more we understand about these complex financial instruments, well, the better prepared we'll be to navigate those risks, to advocate for a system that really works for everyone, not just a select few.
It's a powerful message. Thanks for joining us for this deep dive into the world of non-bank private equity. Hope it's given you a new perspective on, well, the forces shaping the global economy. We'll be back soon with even more deep dives into those topics that matter most to you.
Portions of this podcast were generated with AI assistance.